So today I'm going to talk about using stock options as a form of insurance with regards to housing in the event of a housing crash. Now, there might be some people who just want to protect their own mortgage, like the house that you live in, and there's some other people that might own rental properties, so on and so forth, and they want to protect their investment in the rental properties. Now, this is a strategy I personally have never heard anybody talk about. There might be people doing it. I really don't know, but it's something that your bank definitely would never tell you about. Even if you went to a stockbroker, he'd probably scratch his head and like, what do you? He would probably say, "What are you talking about? This doesn't make sense." Whatever the case may be, but this is a way. You could say it's some sort of like a synthetic way of protecting your real estate investments with the use of equity derivatives, in particular stock options. Now, the strategy is based on a common option strategy called the married put option strategy. And if you just read the definition here, it's on Investopedia. A married put strategy: an investor who purchases or currently owns a particular asset, such as shares, simultaneously purchases a put option for an equivalent number of shares. Investors will use this strategy when they are bullish on the asset's price and wish to protect themselves against potential short-term losses. This strategy essentially functions like an insurance policy and establishes a floor should the asset's price plunge dramatically. Now, there's a few things you're going to have to understand with stock options. I don't know if you are familiar with them, but to some people it's very rudimentary. But if you're new to it, there's going to be certain terms that are foreign to you, and it's just a matter of learning them. So essentially, if you think a stock is going to go up, you're going to buy what's known as a call option, right? And if you think a stock is going to go down, you're going to buy what's called a put option. And now, because there's no index that I know of that's associated with an option with the Canadian housing market, what you could do is you could use like a bank as the investment that the option is based upon, because in the event of a housing crash, you can bet that the banks are going to take a major hit. So if they're about to go down in value and you can buy put options on them, you can offset your losses with your real estate by the gain that you make in the put option. So essentially the way it would work is this. You would look at something, say, like, I always use CIBC just because I have the biggest mortgage book, right? And I've been saying for a while that I think that they're going to go down, and they haven't. But again, that's fine. I'm not really worried about that, because you got to look at it from like an insurance policy point of view. Like when you buy car insurance, unless you pay for it, a year in advance. But let's just say you're paying monthly. You're going to pay, $100 a month or whatever the case may be in the event that you get in a car accident. Now, at the end of the year, if you didn't get in a car accident, they don't give you your $1,200 back. It's just that's what you're paying for. So what you have to look at with regards to this type of option strategy is that it's like an insurance policy, and because options have so much leverage attached to them, I don't know if you could 100% offset your loss, but you could come pretty close, if just by using a few $100s a month. And I'll show you how this works. So let's say, for instance, you have CIBC, which is trading at $115.10 a share. Okay. Now, if you bought a put option of let's say you'd want to buy it a little bit below, just because if it's they call it in the money, right? If it's too far in the money, and what in the money means is that's what it's worth right now, it's going to be very expensive. But if you buy it a little bit outside, it's out of the money, it's going to be cheaper. So let's say you bought one for like 110, right? So you bought a put option for 110. Now, if you bought maybe, say, let's just see here for a second. Grab my calculator here. So let's say that you bought 30 contracts, because each contract with a put option represents 100 shares. So if you bought 30 contracts multiplied by 100 shares, that's going to equal like having 3,000 shares. Now, let's say, for instance, they're charging you like 50 cents each. Or let's say, yeah, 35 cents each. So say 35 cents. So that'd be $1,000. Now, again, that's kind of expensive, but this is just for, you know, illustration purposes. You can do whatever you want. You know, you could go half of that. You could do 1,500. Okay, we divide that by 2, say, divide by 2. So let's say you bought options on 1,500 shares. We'll just say it costs you $525, right, a month. But let's just say those shares go down from, so you got 1,500 shares. Say it goes down from 110, which you bought at the strike price. Say it goes down to $60. So that would be a $50 gain on your options. So multiply that by 50. You'd make $75,000. Okay. Now that's $75,000, you know, you could put in your bank account, and you could make your mortgage payments and so on and so forth. And, you know, with the hope that eventually it'll go up again. This is just so you don't run yourself into some sort of a, you know, a cash flow situation. So by doing this, you know, you're always going to have some sort of money available. Now, again, the thing you have to realize about stocks, there's certain things that, you know, is that their price is contingent on. One thing is how far in or out of the money it is. So the closer it is to being in the money, the more expensive it's going to be. So if you buy it further outside the money, the cheaper it is. The other thing is called time value. So if you buy one that's due in a month, so if you do this every month, it's going to be much cheaper than if you buy them like 3-4 months out, right? Because anything could happen in 3-4 months. But if you keep doing this every month, like you buy put options on a bank, they're going to be cheaper if they're due in a month than if you buy them outside the month. Like if you're buying, you know, say a year in advance or whatever, it's going to be cheaper if you buy them in the, you know, within the month. So you could buy more, protect yourself. You could buy more contracts for less money, so it can protect you more. But again, what the cost is you're going to have to pay that money each month. But there's a lot of people out there that have, you know, 3-4 rental properties and so on and so forth. And to be able to pay $500 or $1,000 or whatever a month to protect their investment, that might be worth it, right? Or let's just say, for instance, you own your own house and you only owe, like, say, $150,000 or something on it. Just buy like $250, $300 a month in put options, protect it, and if there's a crash, you have a nice cushion of money, because you never know. There's other things you have to take in consideration too, like if an economy goes down, there's potential for job loss and so on and so forth. So I'm not really sure if, to a novice, they really understand what I'm saying with regards to this. Somebody who's quite familiar with derivatives or with any sort of financial instruments might have a better understanding of this. But essentially, you're protecting an asset you already own with the ability to make money on the downturn of that particular asset. It's almost like short selling, but you're using derivatives. And because derivatives have so much leverage, in particular stock options, it's a much more cost efficient way to do it. So anyways, that's just a quick video on this particular thing. If anybody has any questions or concerns, drop me a line and I'll try to help you as best as I can. Thank you.